Dear viewers, if you have been following me for a while, you'll know I always pay close attention to insider buying. It is one of those quiet but powerful signals I track to get a sense of whether a company is worth digging into. But before we go further, let us quickly revisit what insider buying actually means. When promoters or the people running the show go out and buy shares of their own company from the open market at the same price that you or I would pay, that says something. It could be a signal that the stock is trading cheap as compared to the intrinsic value, and the promoters are confident about the future prospects of the business. More importantly, they are willing to put their own hard earned money into it, and that means a lot. You see, while we as investors spend hours listening to the management interviews, reading filings, and trying to figure out if a business has legs, the promoters already know. They know what's really happening. So when they choose to buy more stake from the open market, it is rooted in inside knowledge. And here is something even more interesting. Most of this buying does not happen when the market is booming. It actually happens when the sentiments are bleak, during corrections, sell-offs, or when the sentiment is in the dumps. That is when the stock prices tend to fall below their real worth and the promoters quietly step in, building wealth for the long haul. But insider buying in the open market is just one signal. There is another, perhaps even more powerful way to read a promoter's conviction, and that is when they don't just buy from someone else, but they infuse their personal money directly into the business. This can happen through mechanisms like preferential allotments or warrants. In a preferential allotment, the company issues fresh shares to a specific set of investors. This could include the promoter themselves. These shares are priced using a regulatory formula and the buyers pay the full amount upfront. So the company gets fresh capital and the promoters increase their stake. It could be used to reduce debt, fund growth, or even just to ensure enough funds for day-to-day operations. Warrants, on the other hand, are a bit more nuanced. These are not shares, but they are rights to buy shares in the future at a prefixed price. Here, the warrant holder, which could include promoter group, pays only 25% of the total value upfront. They get up to 18 months to pay the rest and convert those warrants into actual shares. If they don't convert, they lose the upfront amount. So it is not just a free lunch, there is real skin in the game. And again, there is lock-in period here too, usually ranging from 1 to 3 years. This means that the promoters cannot just exit the next day. They are betting on the business over time. Now, while these capital infusion methods offer real insights, there is another tool which is used to raise money, which is QIP or Qualified Institutional Placements. These are targeted at raising funds from large institutional investors like mutual funds, insurance companies, or foreign funds. The catch? Well, promoters are not allowed to participate in the QIPs. That is why you mostly see QIPs during bull markets. When the valuations are high, the company can raise money without diluting too much equity. After all, no promoter wants to give away a bigger chunk of their company unless the price is right. Now, there is too much coverage around QIP. After all, smart money is involved. But personally, I find promoter-led infusions through preferential allotments or warrants more meaningful than QIPs. When the people running the company choose to pump in their own capital, not just to buy shares, but to actually fuel the business, that is the conviction you should pay heed to. And the best part, these issue prices, that is the prices at which the shares or warrants are issued, are public data. As a retail investor, if you have done your research and believe in the business, this price gives you a reference point. It shows you the level at which the promoters were comfortable investing. And sometimes the market gives you a chance to buy below that limit. Which brings me to a few real-world examples. Let's start with Anantraj, a company in the real estate space with projects in both residential and commercial segments. The promoters recently subscribed to warrants worth Rs 1 billion at Rs 730 per share. This is higher than where the stock is trading today. What is interesting is that Anantraj has also been making moves in the data center space, converting its existing tech parks into large-scale data centers. But when the news around DeepSeek AI, a Chinese chat box, rattled global markets, anything related to data infrastructure saw a sharp correction, and Anantraj was no exception. The stock crashed on sentiment and hasn't recovered since. Today, it trades below the warrant issue price. Now, that's worth looking into. Another case is Ester Industries, a packaging company which is gradually shifting towards higher value sustainable products. They are aiming to take their value added product mix from 23% to 30% by FY26. The company has some patents under its belt and expects FY26 revenue growth of 17% with margins between 13 and 16% as compared to 11% in FY25. In November 24, it raised money through warrants priced at Rs 158, mostly picked by promoter entities. Again, the stock price is trading lower than that. A signal? Possibly. Then there is 5-Star Business Finance, a non-banking finance company focused on South India with assets under management of Rs 119 billion. In FY25, they issued 4.1 lakh convertible warrants at Rs 770. The promoter paid Rs 193 per warrant upfront, which is 25% of the issue price. As of now, the stock trades slightly below the issue price. The broader microfinance space is going through a challenging phase, but the management has sounded optimistic in its outlook. Finally, there is Imagica World Entertainment. Yes, the amusement park brand. After its debt resolution, the Malpani Group became the new promoter and has infused money through preferential shares and warrants. They raised funds in March 2025 at Rs 73.5 per share to support the existing operations and expansion of new water parks. And guess what? Well, the current market price is below that. To be clear, all these companies have some inherent business risk, and none of these are recommendations or stock tips. These are simply examples, signals worth noticing. Tracking this kind of activity can give you insight into how insiders really feel about their own businesses and the valuations that the market is offering. But as always, it is just the beginning of research, not the end. Let me know if you would like me to track more of these signals for you regularly. Thank you for watching. Goodbye.